recording. And sharing, let's see. Okay, everybody see that okay? And
Yes.
one more thing.
Alan, are you trying to share slides or just your desktop? Because
What's that?
I see your desktop up right now, but I wasn't sure if you were sharing slides.
You should just see a slide right now, just one. It's in Personal Finance and Investing 101/201.
Oh, yeah, I think I'm seeing your other screen.
Yeah, we're seeing all that good stuff, other good stuff.
Okay. Do you see it now? So,
Yes, good to go.
okay, sounds good. Okay, good. Hey, welcome, Grayson. Okay, why don't we get started? Happy Friday, everyone. Hope that everybody's doing well, and thanks for joining today. This first, give a quick disclaimer. Lana, thanks for helping me with that. Hey, this is for educational purposes. I'm not a certified financial planner, and this is not sanctioned or supported by Viasat, but they do allow us to do this. It's really meant to be a discussion, so please bring questions as you have them. And this is not meant to be construed as advice or specific recommendations, but hopefully you find it useful in your wealth building journey. And also want to see if everybody gave a thumbs up or something. These recordings are really long and so really large files. And so if you guys don't mind, I post these somewhere. We can't put them on the Viasat website, but if you guys don't mind, I could find them, put them on a personal website, and then people can download the stuff for free. Is everybody agreeable to that?
Agreed.
Yeah, sounds good.
Yes.
Okay. And if you guys, I see anybody, if you'd like to be on the video, it's better for me because I can see whether you're bored or or if it's something that's not seeming to make sense. So if you guys are fine with going on video, that's preferable, just because it helps me gauge whether we need to stay on a topic or continue on. So just so you know, I'm not up here preaching anything. This is, like I said, this is meant to be interactive, and I'm just showing you here's some of my mistakes that I made, and that's what I'm trying to help people prevent making the same mistakes I did. So like most of you, most of us, financial literacy is never taught in school, nor at the home. And this is important because often we get started way too late and miss those important years. So I try to get the word out as quickly as I can to help people get on the right track as early as possible. And hopefully by the end of this, you'll feel confident to take steps immediately to improve your own financial situation. And then we'll have part 2 next week. Okay, real quick. Gonna launch a poll right now, and if you guys can quickly answer these questions, it shouldn't take long. This is really just to get a gut feel. It's really more to see the first 9 or to kind of see where your preconceptions are on and biases about wealth building. And then the last 5, it's actually a big 5 financial literacy questions, which 2/3 of Americans fail. So don't feel bad if you don't get them all right. But if you can just quickly move through those, and then it's all anonymous, but we'll show the results, and we'll go through the answers afterwards. And is everybody able to click through the poll, hopefully?
Yes.
Okay,
Yes,
great.
just working my way through the questions.
Okay, I'll be quiet.
Alan, I didn't think I was gonna have to be using my brain so much.
Like I said, this is more kind of a gut feeling, but I guess the last five are a
I'm just
financial
kidding.
literacy. Yeah, you didn't sign up for a pop quiz, did you? I was really actually surprised by several of these answers, and going to realizing my own kind of biases and, kind of what I was, maybe what I prejudice as what I heard from my parents or something, that kind of, it's amazing how much some of that sticks with you and it's completely not true. And so sometimes breaking down those barriers is important. Chanson and Dustin, I'm expecting you guys will ace this, and Christian, since you guys have already taken this before. Okay, I think, is everybody completed now? Does anybody still have any questions remaining? I'll give you. Okay, I'm gonna end the poll now, and we'll check the results. Okay, can you guys see the results?
Yes.
Yes.
Okay, so, and can you also see the slides as well? That's what I'm curious about, where I've highlighted the answers.
Part of it's cut off. Yes.
Okay, I'm not sure how best to do this. Sorry, I guess I'm not at Zoom. Lana, I might need some help with Zoom.
No, you're good. You're good, Alan. The poll pops up in a separate box, so we can see your screen, and then we can move the poll answer
cool.
sepattely. So you're doing great.
Okay, great. Okay, this one's actually heck, a lot of people actually said 10 to 30%, but it's actually consistently only 40% of Americans can cover $1,000 expense in emergency, which is pretty scary. Hopefully that's not the case for us that are biased, but that's his across the US. That's pretty normal, which I know Chanson last time that was pretty shocking. You found. Second one was one I always kind of found quite surprising, is that 80% of millionaires are all first gen or self-made, nothing from their parents, or I think they typically say less than $10,000 total, which is a small fraction of a million. But most people are self-made, and I think to me that makes sense, because people that a lot of times come from money, they don't understand the value of a dollar, and so they have rich tastes, and what we see though is 70% of wealth is lost in the first generation. After someone that makes is a millionaire or multimillionaire, and then by the third generation, 90% of that wealth is lost. Pretty sad. Number 3, let's see how many. What do we get? Yep. Yeah, it seems there's 3 people that keep it in, but I think I've seen this before. 89,000. That's the median household income, not individual income. That and this was back in, I think, 2008 or 9, and sadly the wages had been pretty stagnant for most of that time. But what's amazing is about that statistic is, when you think about it, half of the millionaires made less than that in a household by the time they got their first million in net worth, which is actual assets minus liabilities. So not that they've made $1 million total in life. And then I think 4 and 5 are important, especially for young people. It takes time. It takes 28 years. And you think about in the average age of the person when they make their first million of net worth is about 49. Which, you think about people going to college, they come out, it's pretty close. 28 years, it puts them right about 49. And it's just it's compounding, takes time. And so, but the sad thing is, too many people are wanting this get rich quick. I'm going to kill it in crypto or something like that, where what it takes is just deliberate, long-term saving and investing early on, and you'll get there. And then these other things, I guess it's just, I think, a point of, hey, most millionaires went to state schools. They didn't pay a lot of money, which they don't have as much student debt probably as well. So it helps them get to that, be a millionaire sooner. So any questions on these? Let's see. Sorry, I didn't scroll down to see what people were answering. Yep, most people said 49. Exactly 28. It's years. It's good. 6. Yeah, it's actually a large percentage. 90%, have graduated from college. I think that the numbers, they ask about the ROI of college, but still statistically, I think the median wage of somebody with a high school education is like 39,000 versus like 62,000 starting for someone with a 4-year degree. And let's see the next one. Good. A lot of people, 10%. It's actually less than 8% actually attended prestigious schools. And okay, yep, less than 1%. So single stock investing, buying single stocks, that's where certain people obviously they're the super rich, Microsoft, they made their money by their own company and the stock. But in general, it's so much risk. You could hit it big or most likely lose it big. So that's where I'm a big fan of index fund investing, because it's just too risky to put it all in a single stock. Okay, now let's go into the financial literacy questions. Okay, good, everybody. Yep, if you're making some interest rate, you'll have more dollars. Whether those dollars buy more or not less depends on inflation, which is number 2. The question number 11, obviously everybody got right. A little less than today. If you lose money to inflation, that's why you can't just throw money in a savings account and hope you'll do well, and you need to invest. This next one, that's the most tricky one. If interest rates rise, bond prices, they will fall. And it's kind of confusing, but it's a teeter-totter as with interest rates basically. And we're in a rising interest rate environment, so bonds are actually doing worse, as people might have seen already this year, and likely to get worse as we expecting 6 more rate increases this year. Let's see the next one. Good, everybody got that about the 15-year mortgage and single stock. That's actually false. It's not safer. It could provide you a greater return, but it's not considered safer. It's much more risky. Okay, anybody have any? See if we can. Okay, stop sharing that and we can get on. Okay, anybody have any questions about the pop quiz or anything that seemed surprising to you, most surprising?
Alan, when you say that those questions are like for financial literacy, what kind of assessment is that, or how is that utilized?
Well, there's just, I guess I'm trying to think. I'll look up the company that does it, but it's some educational foundation or something provided that, that's and gave it out, and 2/3 of Americans fail the exam. And it's
you don't have to look it up. I was just curious.
Yep. So, okay. Next thing, speaking of those last were not rhetorical questions. This one more is though, and I think it's just always good to think about. Hey, what is your money is a tool, but what do you value? What do you want to spend? Spend a lot on, and where do you want to cut? Because you can't buy everything. And so, just like there was actually a great podcast. Gosh dang it! That Ramit Sethi, he's the writer of "I'll Teach You to Be Rich," talks about your rich life in 2022, and it's just a real good thing to think about of what do you value and what's important. That way, it gives you much more reason, I think, to save and invest, and also where to cut. Okay, here's kind of the agenda. What I'm showing, I'm breaking this up because there's too many slides overall so we're breaking it into 2 parts. And then next week we'll go into part 2. I'll touch on investing, just the accounts right now today, but then we'll go into those more specifics on that next week. Okay, people that have already attended the last time, you can't answer, but what's the real secret to true wealth? And that's to building wealth. It's like, I guess nobody wants to answer.
I'd say discipline, setting and sticking to a budget.
Good. That's the first part of it. Spend less than you make, which comes from a budget. And the answer is simple, but it doesn't mean it's easy. Spend less than you make, invest the surplus wisely, avoid significant debt. You do those things and you will be rich over time. Problem is we too often we spend too much too early and get it greatly indebted. Has anybody heard of the Stanford marshmallow experiment? This is where they took like 4-year-old kids, stuck them in a chair with a little table and put a marshmallow there and said, hey, if I'm going to leave the room, if you can hold off and not eat that until I come back, you'll get a second one. But if you eat it, it's gone. That's it. And then it was an experiment. They're of course videoing these kids, and most of them, of course, ate the marshmallow. They couldn't wait, however, maybe it's a couple of minutes, maybe it was 1 minute. But what's the fascinating thing about this experiment was they followed all these people like 30 years later. And what they found actually is the people that deferred gratification, that got the second marshmallow, actually 30 years down the road were doing much better financially. They were in overall a better, financial situation, which is pretty interesting, but it goes into the importance of deferred gratification, because that's what you're doing by, not spending less than you make and investing it. You're allowing for that compounding and setting up your future. Takes discipline. I like to put everything on automatic. That way you don't have to be as disciplined. It just happens. Time is your best friend. Compounding is magnificent. That's why the earlier you can start, the better. Does everybody know their savings rate? And is it at least 20 to 25%? And by saving, like I said on the bumper, I really mean investing, because if you're just saving in a bank account, you're just losing money long-term to inflation, as you especially see this year. And a lot of people actually getting the 401k match, you can add that into your savings rate. So that's an additional 5% for us if you match, get the entire match, which hopefully all of you are, but we'll go into that. Also, how long does it take your money, if you have a certain amount of money and it's at a certain rate of return, how long does it take that money to double? Does anybody know that answer to this, or the thumb rule?
The rule of 72.
Perfect. Yep, the rule of 72. So what that means is you divide 72 by the rate of return of your investment, and that'll give you an idea of how long it takes to double. For example, a lot of people use 8% as a good standard, rate of return of the market. So 72 divided by 8, and that's 9 years. It takes 9 years to double your money. And that's I actually like to use kind of 7%, because that's what they've consistently shown the market beats out inflation by over years. And so to me, that's just a better number to use. But and that's just for thinking of how much money do I really need, because you can think of it in today's dollars instead of future dollars, which is it's hard for my small brain to compute what 30 years money is like, what money's going to be like in 30 years from now. Okay. Whoop. Where is, okay. And how much money do you need to retire? Do you need, well, some. Do you need nothing? Military pension for those of us that retired from the military, Social Security. Sue Zorman, classically known for saying everybody needs 5 to 10 million, but is that true? How do you know how much you need to retire?
A Trinity study.
Trinity study. Yep. And it's also Bill Bangman. That's the. So it really depends on your expenses, I guess, ultimately. But exactly, the Trinity study determined the 4% rule, and it defined basically what financial freedom or financial independence is, and that's having enough money to pay one's living expenses for the rest of one's life. The Trinity study, which you mentioned, is it was a study and they showed that 96% of the time, if you were able to keep a safe withdrawal rate of 4%. The 4% is the rule of thumb for the safe withdrawal rate. So once you have invested at least 25 times your annual expenses, that money, assuming this was, I believe, a 50-50 stock bond portfolio, which is pretty conservative, but 96% of the time they were able to live at least 30 years, because they were considering retiring at 65 and living to 95 and not run out of money. Over half the time, about that money increased 4 times. But it's, this looked at all like the last a little over 100 years and various times of when you actually retired, because those first years you retire, you could have sequence of return risk if the market's really bad, and all of a sudden you're selling equities when things, when the market had plummeted. That could have a significant issue. This year, people are talking, there's real debate on this 4% rule, but it's a good rule of thumb. If you're going to have retirement longer than 30 years, you might want a little shorter, smaller one. like I think 3.33% has been shown that no matter how many years you need, it has worked in any time. It's worked 100% of the time that you will not run out of money. But then obviously to have that, you got to save, invest much more. The Morningstar has recently said it's 4% in this interest, environment. Low fixed income doesn't work, but it's a rule of thumb. It's a good rule of thumb because they already looked at all these crazy different situations, including, the 70s and 80s with the super inflation. And then FU money, that's exactly what it kind of sounds like. This is a lot of people, it's a good check hey, you have 2 years worth of money. So if, say you're in a really toxic environment, if you could just, leave and figure out what to do, but that's a comforting number to have. Any questions on this? Quiet crowd today. Okay, spend less than you make. Stephen, you hit this up first. Like saying what do you need to be wealthy is budget. I really say I like pay yourself first, and we'll go into each of these 3 things. So, but budgeting, I don't budget regularly, but everybody has to at some point. You need to figure out what are your expenses and look at it over 6 to 12 months. That way you're covering all those expenses like car registration, car, insurance, if you pay it, lump sum at 6 times, those year-long subscriptions, all those things that you might not be thinking about, homeowners insurance, renters insurance, et cetera, that you need to make sure you account for those. And then I keep those as just a running monthly total. Whether you pay it right then or not, you can save that much into that whatever bucket that you need. But ultimately, like once you've done that and you make sure that your obviously expenses are hopefully much lower than your income, the key to me is pay yourself first. Set everything up on automatic. 401k, everybody, when you start Biosat, it'll auto put you into 5%, which is too low. I want everybody at least at 10%. But at least it does auto enroll you, and it puts you, if you didn't do anything, it'll put you in the target date retirement fund that for when based on the year when you turn 65, which is good. It's a kind of an 85% solution, I'd say. Down the road, you want to adjust that to individual things, in my opinion. And personally, I think they often go too conservative. But that's the kind of thing. Your IRA, having money drawn out automatically each month from, you can set it up for your paycheck or just right from your checking account, but get those all on automatic. That's how you'll be successful. Also, special pays and bonuses. You're doing fine without that money, hopefully. So don't spend it all. Invest at least half of it, or all of it if you can. Everybody needs a treat to treat themselves, but the faster you can get this pool of money working for you, the better. Okay, and so one of the key things in your investing rate, your savings rate, but like I said, saving, when I say saving, I mean investing, is far more important than your rate of return when you're young. And too many people spend a bunch of time trying to, thinking they're going to find one stock or something where they're going to shoot the moon, and it's not going to happen. And if it does, they're going to get probably hurt later. But more important is just save as much as you can, because the more you get that larger pool started, the better. I circled a couple numbers here. Hopefully everybody's savings rate is far more than 5%, but just showing that, hey, look at how much, if you, look at a 30-year time horizon. If somebody only saved 1% though, and got 10% of return, much better return, they still have less money than someone who'd save 5% and only had a 1% rate of return. Hopefully you're greater than 20% savings rate. And, with the market, you're making that, something like 8%. overall, and just stick with it. But the key is to get the savings rate is far more important. Instead of spending all this time trying to figure out what exact thing to do, just buy the whole market and work on becoming better at your job and getting raises so you have more money to put away. Okay, biggest 3 expenses for the average person: housing, transportation, and food. I think everybody knows that. Especially in Southern California, housing is insane. But here's kind of some rules I like, for how much you want to spend if you're buying a house, or just overall housing expenses. When I was in the military, we had a housing allowance, and I tried to get the housing allowance to cover not only all of these costs like utilities, but cable and cell phone and everything else. That way, I had the rest of the money I could just allowed me to put more money away. And too many people in the U.S. are house rich and otherwise poor, and never get ahead. Does everybody see that 23-8 rule for purchasing a car? It's kind of conservative, but far too many of us, especially like coming out of college or joining the military, is where I saw it terribly. But they'll buy this ridiculously expensive car that's a depreciating asset, and it completely messes them up. So this is a great rule of thumb of how much a car you can afford. Say you put 20% down, you can pay it off in 3 years, not 6, which is like the average term on a car now is 72 months, which is terrible. And then the car payments for your entire household income, for your entire house. So if you got 2 cars and payments on both, some of those payments should be less than 8% of your gross income. Now, that doesn't seem like a lot, and you can take a larger term, but the whole point is paying it off in 3 years, and that payment you make to pay it off in 3 years being less than 8%. And then food, we all know about food. And I don't know, that was one of my mistakes you guys saw up there, how much I've blown over the years. Fundamentally, cars a monthly car payment should not be a normal expense. Too many people think that that it's fine just to always have a car payment, and that's just terrible. You should invest more than your car payment is every month, and then the quicker you can get a car paid off, or just buy used. This is the weird time where a used car is actually maybe more expensive than new. That'll change back to normal too, but that's probably where I saw, especially in the military, the most wealth lost was on a stupid car. The other thing, consistently raising your standard of living by investing. I like the idea of saving at least half of your raise. Did everybody, we got raises this year, so did everybody increase their allotment to their 401k if they weren't already maxing it? If not, did you set it on auto increase so that it automatically comes on, automatically starts increasing? And then does everybody have at least 10%, saving at least 10% in the 401k to get the max match? Our match it pays 50 cents on the dollar up to a maximum of 5% match. So you have to put in 10% of your paycheck to get the full 5% match, and that's free money. On here, you see the credit cards. It's so much easier to spend than using cash. But the real killer, I think, Christian, you said you went, after the first time we did this, went and saved like $100 a month by looking at your subscriptions. That's a homework though. Everybody, that's the new killer. Everything's a subscription. And how many things do you really need? Can you really not listen to the ads on Spotify or something like, but they just add up so much. So every 6 months, at least, people should go back and look at all their subscriptions and cancel things that they're not using, because that money adds up quickly. Any questions there? Okay, avoiding significant debt. This is tough here with the housing prices. It's insane. Interest rates are going up, so we're going to see leveling off of housing prices. But I get it. It's California, Southern California. It's crazy. San Diego just overtook in, I think, what, March or February. I think end of February took over as the most unaffordable housing market in the entire U.S. It went ahead of San Francisco, and actually 4 of the top 10 are in California. It's crazy here, but the credit cards, that's hopefully none of you hold a balance. That's just throwing money away with those ridiculous rates, and I wouldn't cancel your cards because that will hurt your credit rating. But if you can't pay off the balance each month, we need to have a talk, because that's you're just setting yourself up for the opposite of the kind of compounding we want, which is building your net worth, not destroying it. And then student loans, it's that's tuition costs have went up greater than inflation since the 70s. They've actually studied this recently, and it has slowed down much more since 2000. It was actually the 70s through 99 that they went up really fast. But it's also all the costs associated with school, the room and board that's killing people as well. But okay, saving versus investing. First thing I want to point out, I've got some friends that are insurance agents, and so they won't agree with me always on insurance, because that's where they also make their money, though, is commission by selling whole life, permanent insurance. But don't think of insurance as an investment. It's protection against the loss of life. And if you are young, or if you are single and nobody relies on your paycheck, you don't really need insurance. You should just be investing that money. And buying a whole life policy is not where you're going to make a return. Like it shows, Consumer Reports did a study, and that whole cash value that they try to sell you on, it only made like 1.5% to 2%. Didn't even keep up with inflation. But they'll show you these charts that show like a 7%, beautiful rise, but it's not true in general. And for the vast majority of people, I do like this analogy, though, that buying the cash value life insurance, it's like buying a car with a built-in dishwasher. You don't need a dishwasher in your car. That's not what. You put your money into your retirement accounts, brokerage accounts. That's where you're investing. For the vast majority of people, I believe term life insurance is better than whole life. It is important to have protection, obviously, especially if people depend on your paycheck. But term life insurance, it's so much more affordable, and you set a time horizon for how long do I need this until I can self-insure, meaning I have enough money that it doesn't matter. The mortgage is paid off, your bets are paid off, and you have enough in your to support you, and if you pass away, your family, for what they need, getting your kids through college, etc. Ultimately, and time horizon, this is where saving and investing are different. Investing, you got to think long term. I'm saying at least 5 to 7 years, hopefully even longer. And really, when you're putting this money away and the market's fluctuating, you should be thinking much longer term, 20 plus years out. The market will recover. But saving is short term. So anything less than, say, like 5 years, you never know what's going to happen in the market, and that's tough, because when you might need your money, it might be also when there's a recession, the market tanks at the same time, of course, and then you've just hurt yourself. So while it's frustrating to see savings accounts not making much of anything, for certain things like an emergency, or things where you definitely need short money in the next few years, you need to be conservative there. But I would definitely keep it in this high yield savings account versus brick and mortar. So you at least are making 10, 20 times the interest rate of those. For emergency fund, I like to think 6 months, and that's non-discretionary. So you can cut out a lot of those things, but rent, food, basic food, gas, you know, transportation, those things you have to have, utilities. But what they've shown is in real tough recessions, it can often take 6 months for people to find employment. So it's much better to be on the 6-month side. Some people even, you know, very conservative, go on to, you know, 12 months. But one of the nice things about accounts we'll talk about soon is like the Roth IRA can also be contributions to a Roth IRA can be used as an emergency fund if needed, which is great. Okay, so we're going to quickly cover the accounts that, how do you invest for retirement? Just quickly touch on, and I have a separate discussion that we'll do in 2 weeks where we go deep into these accounts. But your tax advantage ones, this employer sponsored accounts like the 401k that we have. Other people, they have different names for it, like 403b, TSP, you know, if they're either nonprofit, state, local, or federal government, but they're all basically the same thing. And both 401ks, fortunately, like our plan, has a traditional and a Roth component. Somebody want to explain the difference between traditional or pre-tax and Roth accounts?
The Roth would be after-tax money that you're contributing, and the traditional is pre-tax money, so you get taxed later when you're you're retiring.
Exactly. So pre-tax is also known as standard or traditional. It's, you don't pay taxes now, but all that money then is taxed as income later, all the growth, everything else. Roth, you pay your taxes now, and then all that growth, though, forever will not be taxed. So depending on, usually it's best when you're in a low tax bracket, take advantage of the Roth, get as much of your Roth bucket filled up as you can. And then as you hopefully make more and more money and get in a higher and higher tax bracket, then you want that tax deferral. Hey, I'm gonna, you know, fake out Uncle Sam, push the money away, and then later pull it out when you're retired and have a lower income in a lower tax bracket, and you'll get taxed at a lower rate. So the health savings account, that's the most tax advantage account there is. And well, like I said, we'll go into that more detail, but you have to have the high deductible health plan, but you can sock that money away, and instead of paying for it, you pay for your medical expenses out of pocket, and then invest this money and let it grow forever. And you can reimburse yourself 20, 50 years later with this money, and you just have to keep track of your receipts. So, and it's tax deferred going in, tax-free growth, and then tax-free earnings. It's like the benefits of a Roth and a traditional in one, so long as it's used on qualified medical expenses. It's a beautiful thing. And then individual retirement accounts. Everybody should have one of these in addition to the 401k. And I would say most people open both a traditional and a Roth IRA. And I'll explain more about that later, but there's income limits on the Roth IRA. And so sometimes there's a way to backdoor it where you have to put money into a traditional IRA. And then once that money settles, you can convert it into a Roth IRA and have it grow tax-free forever. But it's kind of a two-step process that Congress is also trying to get rid of. Okay, and then the non-tax advantage accounts. Along with those, you do need a taxable brokerage account, which is basically at the same place where you open up your IRA. And everybody here already has one, most likely, if you either have employee stock purchase plan or RSUs, and that's through E-Trade. I have moved my money out of E-Trade into the company I use that I've had a brokerage account with for a long time. But E-Trade is fine. I'm a bigger fan though of Fidelity, Vanguard, and Schwab. They're great, low discount brokers. And then there's a couple other things. Treasury Direct for I-bonds. I know, Christian, we were talking about that the other day. And then just like people that want crypto, you can't typically buy crypto in the typical brokers, you know, so you have to go to like FXUS or Coinbase or something like that. But I'm not here to talk about investing in crypto right now. Okay. But the key is to have all of these. And one thing for the IRAs and the taxable brokerage accounts, it's not investing when you put money in. It's a two-step process. You have to put money in, and that's sitting in cash, and then you buy equities. Unlike the 401k, where it's either already set up for you, or you go and set up an allotment, and then it puts that money every month or every 2 weeks into that division of funds that you have. But that's not the case with an IRA and a taxable brokerage account. And that's where people have screwed up before. They put in all this money away, they're thinking they're doing a great job, but it's sitting there in cash, just like a brick and mortar bank making next to nothing. Okay, this is what I consider we're getting towards the end for today, but I want to put out kind of my thoughts of hierarchy of saving and investing. First, you need to have $1,000 cash minimum, and then be building up your emergency fund. Like I said, that Roth IRA, contributions to the Roth IRA, not conversions, contributions can be pulled out immediately. So if you're having trouble building up your emergency fund while also making Roth IRA contributions, which are currently limited to $6,000 a year, you can put money into your Roth IRA. And if in emergency, you really don't want to, because you want that Roth money to build and grow, tax-free for a long time, but you could pull that money out. So it's a tactic to use until you can, have your emergency fund already sitting there and still be putting away to 401k and IRA and all the buckets that you want. Get your free match. It's hopefully everybody's doing at least 10% to the 401k. If they're not, we need to talk, because we need to figure out how to get to 10%, because you're just throwing money away. ESPP, why I say that's and that's kind of a push between paying off high interest like credit cards. We get a 15% discount immediately off the lowest price between the first day. Yeah.
Is 10% the max you can contribute?
No, to the 401k.
Yeah.
You can contribute. The maximum you can contribute when you're under 50 is $20,500 for the year. So, and how ours works actually is that's we were talking about this before, but you could put in a larger percentage to where you fill that cap of 20,500 before the year ends, and it'll stop in you'll have a larger paycheck.
That's right. I just
and
remember
how the thing is, like in the military, they don't true up, and we don't really have a real true up, but I verified this with our benefits, that they will take the average throughout the fiscal year, which our fiscal year is April 1st, right through March 31st. And if your average contribution was 10% across those months, you'll get the full 5% match. But you can contribute well over that. And, ideally, that's why I say, though, here, first get that match, get that 10%, Dustin, then then put in the IRA and HSA, because that's better. You often have more flexibility on what you want to invest in, and the HSA just has that triple tax advantage. So you want to fill those buckets up before you go back to filling up the rest of your 401k. If you can fill up the 401k as well, you see that, what I say, in hyper and accumulating wealth, go fill up some, put some into your taxable brokerage account, which I think of for shorter long-term goals. That's where I used to invest, and then eventually sold some equities to put the down payment on the house. That's just what I did, but I didn't have an immediate time frame when I needed it. But those, things like the mortgage and stuff like that, that's where you pay off after you've taken advantage of the other things that'll, especially with our low interest rates we have right now, you're going to do better in the market long term than paying off that low interest. As people get closer to retirement, understood, it's definitely want to get to be debt free, but take advantage while you're young. And these are the best options, I say. The ESPP, why it's so high, is you get that 15% discount immediately off the best price between the first day, say January 1st and June 30th, whichever the stock ticker price is the lowest of those, we pay 85% of that. So you're automatically making 15% in 6 months. So it's hard to beat. It's free money, just like the 401k. Take advantage of it, and then you can sell it and rediversify it or what have you. But it's hard. That's a hard one to beat.
Alan.
Yeah.
For ESPP, would you recommend just selling it immediately as soon as it makes a purchases?
Christian, that's our next big discussion. Okay. is going to be that. So there's several things to consider on that. But in many cases, I'd say that is almost a lot of times the best thing, because you don't want all your money in Viasat stock, and you can go and put it into a much more diversified account. But our next discussion we'll go into that in detail. Okay, next steps. Here's things. Does everybody calculate their net worth? Something, even no matter how, and people just coming out of college, they probably have a negative net worth, but I found it to be very valuable in seeing how that changes, and it helps motivate you to save and invest more. And as you can see, your net worth gaining over the quarters, over the years. I wish I'd started that longer. Yep.
Empower actually has a tool where you can connect your brokerage accounts, bank accounts, your car payments, or the financial services, and then it calculates your net worth for you, or adds all up for you.
Yep, they do that, but for me, I don't pay attention to that as well. And doing a snapshot every quarter or every year is, you see that change, and it's for some reason it's more meaningful just for me throwing the actual numbers in once a quarter and watching. And I have a tracker that it'll provide a graph. It shows how it's changed over the last quarter, over the last month, over, and say from the beginning of when you started actually tracking it. So yes, they do. And so personal capital, people use that as well, but I still like having a spreadsheet that does, that you manually put in numbers, and you can really see how you're doing as time goes on, and how it's changed month to month, over the years. Okay, so, but like I said, if you guys want, shoot me an email. I'll send you over that net worth tracker. Get your free money. If you're not already at 10%, get there. Try to get the max ESPP. Those, if you haven't signed up for that already, next one, email will come out probably in May. To sign up. If you already have signed up, it'll keep consistently at where you're at, hopefully at the max of 5%. Open up those individual IRAs. Like I said, I like Vanguard, Schwab, and Fidelity. M1 Finance is another interesting one, but they just have the lowest fees and greatest options. I feel like them, and you're not paying for expenses that are just taken away from your personal wealth. And then, like I said, get everything on automatic, and you'll be surprised. Like Simple Path to Wealth, one of my favorite books on, by J.L. Collins. He said that one of the best things you could do is just shove as much money into he uses VTSAX, Vanguard's total U.S. stock market, and just keep pushing, buy and hold, shove as much as you can, and then in 40 years. You probably need a doctor when you go actually look at the account, because you're going to have so much money, you might have a heart attack. Okay, other items, like I said, with the IRA, open up a brokerage account at the same place. You don't really need to fund these right away, but just get them, you get them opened and then fund them as you can. Personally, I like I said, low cost, broad-based index funds for the vast majority of my money. Here's some common things that make up a kind of a globally diversified portfolio. And be patient. Just you're not smarter than Warren Buffett or Peter Lynch. Just buy the market, like they say, and the returns are great. It's a one time where being average is good. Market returns average market returns are great and will make you wealthy. So buy and hold, be patient. And investing should be boring. Gambling is exciting, but we're not talking about gambling. We're talking about investing for the long term. Okay, as mentioned, budget. Take a look at least 6 to 12 months to make sure you cover all those costs, and then save more next year. Save at least half of your raise. Auto invest, and just stay with it. Don't change your. We're emotional animals, and it makes us terrible investors, actually, because we have loss aversion. Losses are much worse than gains in how we feel emotionally, and we make poor decisions of selling at the wrong time, buying at the wrong time, where we buy high and sell low, which is the wrong thing to do. But and then start today. Anybody have any questions? Here's a net worth if you want to see where you should be. Or this is from the Millionaire Next Door, and actually the Money Guy show, they have a cool way if you're under 40 how to look at this, but they have the average accumulated wealth and then a prodigious accumulated wealth, which is what we all want to be. We don't want to be average, but this is a good thumb rule you can use on yourself to see, hey, where am I at, and am I making the right steps? Or so like I said, you can shoot me an email if you have any questions. And then here's some quick questions for you. How was this? Was it too basic, too fast? And do you feel like you can take some steps now, set up your, improve your own financial situation? Okay, and there's some other topics. Like I said, Christian, ESPP and RSUs is the topic for May. We'll get into that and those specifics, and we'll talk capital gains and losses as well, short-term versus long-term, and whether selling ESPP right away makes sense. But if that's it, I've got to jump to another meeting as well. Hope you found this useful, and have a great weekend. Thank you.
Hey, thanks, Alan.
Thank you.
Thanks, Alan.
Thank you.
Thank you.
Thanks so much, Alan.
Thank you.